So once again, this is Isaac McCabe, and he's going to present our seminar tonight. So Isaac, thank you.
Thank you, Randy.
Appreciate you.
Good evening. I'm glad to come out here. This is something I was looking back on my notes when I first started thinking about the concept for this class, and I started thinking about is it possible as a Christian to work in financial services, for one, right? And two, if we do, how do we take what we know and use that for the ministry of our faith, right? What has God taught us that we can apply to help build up the body using my vocational knowledge? And so it occurred to me, that in my experience, churches and nonprofits didn't have a lot of education about money and monetary concerns, and that I could show them some techniques to help hopefully raise more funds. And I thought with that, maybe we can better fund the body of Christ, and as what I like to call defund the enemy. And by that, I mean take more money from those organizations that use it essentially to fight against the church and freedom of religion, and direct those funds instead more constructively to educational institutions, churches, nonprofits, and that kind of thing. So I thought, the Lord must have me here for a reason, and so about 2016, I started kind of pulling together some of the info that I wanted to talk about. 9 years later, I finally finished it, right?
Sounds like
Work interfered a little along the way, and I like to deliberate a long time and then work fast when it's time to get to it. And so I've been looking forward to an occasion like this to share the 6 W's of planned giving with you. And just a brief kind of bit about my background. As I mentioned, I'm Isaac McCabe. My primary role, I'm Vice President of Mutual Savings Association, an officer of that. We are a kind of community savings and loan domiciled in Leavenworth, Kansas, and serving the communities kind of between Topeka and Kansas City. So that kind of 30-mile band in there. Leavenworth, Tonganoxie, Oskaloosa, Bonner Springs, Eudora, those communities are where we have branches and operate. My second and primary daily role there is as the principal of Financial Strategies. Financial Strategies is our full-service independent insurance agency, and coupled with that, I'm a registered investment advisor, representative of Money Concepts. And so I combine insurance and investment management in order to kind of operate our wealth management division, we call it in the bank. So helping folks with money figure out what to do with their money, or folks without money figure out how to handle those money problems, right? The two kinds of money problems, too much money problems and too little money problems, right? And most people have one or the other. I'm a Series 6 representative, got that in 2003, and a Series 7 representative, got that in 2012. Series 7 is basically your individual stock, bond, stuff like that, license. So basically all the financial products. I'm licensed in all the lines of insurance, all the lines of investment. And so I like to think that gives us a unique perspective and some objectivity about how to put these things together, and coupled with the fact that we work with the savings and loans, so that the banking and the balance sheet, management is another aspect that we consider, right? So many firms are just specialized in one of these areas, and it's important, all those things, I think, because they come together in our lives, right? And they need to be synchronized. And so that's my primary role, my experience. I've been doing it, as you can see, since 2003, so about 22 years now, and at the current business since 2006. So all the people in the industry around me keep changing, but I kind of stay the same. I'm still sitting there in the face. Sometimes they come to me and they're working for a new company now, and it's like, oh, who do you represent these days? But I'm still here. and I plan to still be here. I've got a 2-year-old son as my youngest, 5 children. My oldest is 25, so I've been having children for a while. I'm basically raising a second generation right now, and I told my wife I think I'm about ready to hold some grandbabies instead of my own babies,
Right.
even though we're delighting in the 2-year-old. You know, they keep you young. And another son. I've got bookend sons and 3 daughters in between. So anyhow, enough about me. The course is called the 6 W's, and they are why, who, what, where, when, and how. I know is a bit of a reach. But it's got a W in it. It's got it, so that's why we have to underline it at the end, right? And it just wouldn't be right to say 5 W's and an H. So there we go. We found the 6th W in how, in case you're wondering how we got there. So we're going to talk about these in regard to your planned giving, and all those areas. We'll discuss how they pertain to you, what you can do in each of those, or entities. And we'll start with why to give, the benefits and basics of charitable gift planning. I would say the why, one thing I've learned in financial planning, the why is far more important than the how. In life, the why is far more important than the how, right? Why do we do something is what gets us going. And so there are a number of benefits of planned giving that could motivate you or supporters of the organization. Give less to the IRS. That's always a pretty good motivation. When I say defund the enemy, right? The government in many ways actively waging war on conservative organizations. They do that with the funding from your taxes, right? So if we can give less to the IRS and more to the organizations that support your belief system, then that's an important thing to do if we know how. In fact, we're called to be, wise as serpents, right? And so it's something that we have to know the rules, and then we have to learn how to use those rules to our advantage. Or as Trump likes to say, well, you wrote the tax code, if you don't like it, then change it, right? I'm just following the rules. All right. So you may be inspired to help people or animals, whatever you choose, to improve society or to improve your environment. Just to direct your resources, to have more control over what happens with things when you're done with them. Many of us don't die broke, right? And so what happens to that remainder? And as I like to tell my clients sometimes, you better figure out something to do with it, because if you don't, your kids sure will, and they're not going to be near as depriving of themselves, as you may have been. To reduce fraud, waste, and abuse. As we've seen, like with Doge and those type of things, there's plenty of waste in the system. And charities and nonprofits are far more efficient, right? They're kind of the original American way of dealing with something. If we saw a problem in our community, in our state, in our neighborhood, we'd get together and we'd fix it ourselves, right? And we didn't need a large federal bureaucracy to do that. And it was fundamentally understood that was efficient and cost effective. To prevent dragon sickness. I don't know if any of you have ever read like the Lord of the Rings trilogy, or the Hobbit, really, where there's Smaug, the dragon, that is sitting on his massive gold hoard, right? And even though he's on a mountain, a literal mountain of gold, he loses one jewel and he burns down a town, seeking it out, and cannot rest until he finds it, right? Even though he has more than plenty, he's pursuing and collecting it for the sake of collecting it itself. And I've seen this in people who pile up wealth and continue to pile it up and live like a pauper and don't give it away or anything else, and the pursuit of the number becomes the end unto itself. That is kind of like a mental illness. I call it dragon sickness, right? And so if we, what was it my pastor said his father used to tell him? He said, it's hard to, I want to say love something if you don't learn to give it away, or hard to become, addicted to something if you don't give it away, right? And so he wanted them to learn how to give money away in order to sort of inoculate yourself against dragon sickness, against the love of money, right? And so we're not going to hold on to it too tight if we get in the habit of giving it away. Obey God, right? He tells us to give, that he didn't give us all of our treasure just for us to pile up and sit on. And feel good. When you do good, you feel good, right? And when you obey the Lord, you feel good. And so those are some of the key reasons and benefits to planned gifts. So, some of the basics of planned giving. 1, charitable contributions are itemized deductions. Even though a gift to charity may be tax deductible, is tax deductible, you have to have enough deductions to meet or exceed your standard deductions in order to kind of realize that benefit. And this year in particular, there's no deduction without itemization. Okay, so now that is changing a little bit, but so in order to realize the deductibility of your gift, you have to exceed the standard deduction. Well, what are the standard deductions? In 2025, it is $15,750 for an individual, $23,625 for a head of household, almost $32,000 for married filing jointly, and then another $1,350 per dependent, right? So a married couple with 2 kids might have about $33,200 of standard deductions, meaning that if they don't gift or have, and combined with things like mortgage interest, taxes that you pay, state and property taxes, healthcare costs, all those things. Well, most of us don't have enough of any one of those things to itemize. And I know personally I do end up itemizing, but if I didn't have my charity or I didn't have my mortgage interest, thankfully I don't have that much medical expense, at this point in life. If I didn't have some of those things, any one of those things, the state taxes that I pay, I would not be able to itemize. And so many people, even though they give faithfully, and we don't give just for deductions, we give for all those other reasons we talked about. But what if we can realize more benefit from our gifts by doing it in such a way that we can get those deductions? Okay? So as I said, in the 2025 law, you have to itemize to get your deduction for charitable contributions. In 2026, apparently it's the OBBBA, for short, the One Big Beautiful Bill Act to rule them all, in the Lord of the Rings analogies while we're rolling with them. A new rule goes into effect that will allow non-itemizers to deduct up to $1,000 for single filers or $2,000 for married couples. The good part is they do have to be cash contributions. So they'll get some deductibility. A couple will be able to deduct $2,000 without itemizing, what we would call an above the line deduction. Okay? Okay, so that's the basics of your deductibility.
I have a question.
Yes?
The cash donations, that doesn't mean paper money. Is that right?
You're right. I mean, it does, but it also means other kinds of money, right? And so I don't know if it's on this slide, but I've got a slide where we've got actually a list of everything that counts. But of course, credit cards, checks, cash, direct deposits, all those things do count. But, clothing, all those physical property will not count.
Got it. Okay.
And there are other things that have value, securities and stuff like that, that also would not count in that way. And we'll talk about those. So one of the ways we can deal with the problem of not being able to, potentially not being able to deduct my charitable contributions is through a concept called lumping. Lumping your gifts. Not the most flattering term, but it's pretty powerful. And lumping is a strategy of consolidating multiple years' worth of donations into a single tax year instead of spreading them out annually. In other words, what if instead of giving $3,200 a year for 10 years, I gave $32,000 1 year so that I could itemize and deduct? Of course, we need just a hair over that, $35,000 maybe 1 year, so I can itemize, be able to write all those off and still get those standard deductions, that $32,000 standard deductions each year after that. So why lump donations? Well, they can take their standard deduction or itemized deductions, which includes charitable donations, medical costs, mortgage and auto loan interest, state and local taxes, etc. So all those things go together your charitable donations, medical costs, mortgage and auto loan interest was added. That's a new one. Didn't used to be able to deduct auto loan interest. And state and local taxes, right? So as I said, typically if you don't have the charity, you don't have any one of those pillars, you may not have enough deductions to hit your itemization. So the answer is borrow a lot of money, right?
Yeah.
No, or give away more money, right? That might be a more Christly approach. The standard deduction, as we talked about, is relatively high. I'm sure you wish all your donors did, but I'm sure most of them don't give over $32,000 a year. But my goal is to help show you how to empower people to be able to do bigger gifts that do reach into these kind of tiers. So you got to get over the standard deduction by combining several years worth of donations. You itemize that year to get the tax benefit coupled with these other expenses, and then the other years you can still take the standard deduction. There are donor advised funds, so often called a DAF for short. People often lump contributions into donor advised funds. That allows them to make a large contribution into a fund that is invested typically, and then to disperse that money over time. Therefore, they can take that whole deduction today. I don't know about you, but I give to a lot of different charities. Sometimes it's kind of nice just to have a pot of money sitting there that you can just write the grant out of whenever somebody catches you on the phone or whatever, catches your fancy, and you decide to issue a grant to them. So that will allow you to lump that stuff together, create a fund, deduct what you put into it, and then disperse it. It could be over any amount of time thereafter. Okay, so it's a pretty powerful tool that paired with this lumping concept. It's kind of like your own little endowment fund, if you think of it that way. They call it donor advised fund because the fund itself is a 501c organization. There's a number of administrators for them, but they are a not-for-profit that administers the funds, and so that's where you get your whole taxable write-off when you contribute to it. And then they disperse the money according to how you, the donor, advised them.
So it'd be like the National Christian Foundation.
Correct.
Servant Foundation. Yeah.
So the other good thing, an above-the-line deduction, charitable contributions are business expenses. Okay, so if you have a business, a corporation typically, then you can deduct there is no standard deduction for businesses. Businesses itemize everything, right? They add up all their expenses, they add up all their income, the difference is the profit, they pay tax on the profit. So they can direct money into charity as an expense, and they're able to deduct it fully. There are limitations to that. We'll talk about that. But that's what we'll call an above-the-line deduction, right? One you get without itemizing. Or in the case of a business, they itemize everything. So charitable contribution deductibility is limited by your... Yes, sir.
Does that include sole proprietors, or do they have to be?
We are going to get to that. Sole proprietors, though, are treated pretty much like the individual. Everything's flowing through to you as an individual, and you're going to follow the individual rules. But yes, there is definitely a slide on that. So the deductibility is limited for an individual to by their adjusted gross income, or AGI for short. And you may have heard the term a lot, and if you're like me, wondered, where is that? What is AGI? Well, and I think this was the 2024 1040. The lovely part about the IRS is at the end of the year, they'll tell you what the rules for last year were and how to fill out the paperwork, right? But this is, I think, the 2024 1040, and it was line 11. It says adjusted gross income. That's the number. The interesting thing about it, though, or the key point when you look at it, is you can see then below that is where the standard or itemized deductions come in. Okay, so before you take your standardized deductions, you'll get a look at this number, this bigger number, that will be the basis of how much you can donate. And so you cannot deduct more than 50%, or 50% annual maximum is the ordinary income deduction. So if I had 50,000 of AGI, then I can deduct up to 25,000 of charitable contributions that year. Okay? I would put those contributions together. I would base it off of line 11, and I'd put those contributions together with any other deductions, the state taxes, the auto and home interest, and local taxes, and I would put them on my itemization. I'd take it off there on line 12. That would lower my taxable income at the bottom line there on line 15. So your cash contributions question, yep, payments made by cash, check, electronic fund transfer, online payment service, debit card, credit card, payroll deduction, or transfer of a gift card redeemable for cash. Per IRS publication 526. Yeah, I like to joke, I'm not an accountant, I just play one at work. Actually, everything I got for you is just going through, compiled from the IRS publications, and as much as possible kept it in their words so that I know that it's compliant, right? I'm not an accountant, but I can read. And so when we have tax references like this, it'll be what the IRS said specifically. There's a 30% annual maximum capital gains income deduction. And so you can gift property that has capital gains. We'll talk more about that later. The beauty of doing that is that charities, what kind of taxes do they pay? No taxes, right? You're a tax exempt organization. And so if I sell property that has capital gains, I have to pay tax on it. If I give it to the charity, you can sell it tax-free. Right. That's a beautiful thing, especially if the main reason I'm not selling the property is because I don't want to pay the taxes, which I see a lot. There is a 30% limit on how much of that donation can be capital gains. And we'll talk about what happens if I give more than that. We'll talk about it now. Unused deductions carry forward up to 5 years. Okay, so let's say I had given a $100,000 appreciated piece of property and I had $60,000 of capital gains in it. I could only deduct, in that $50,000 income situation, I could only deduct $15,000 a year of the capital gain, right? So I'm going to get to deduct that for several years until it's all used up to 5 years. So for a contribution to be deductible, it has to be paid to a IRS qualified organization. There is a tool there called the TOS tool. The site is listed on your slides. By the way, your slides copies are in your folder. So if you need them to refer back to or write notes on, you can use those. My card is in there as well and stuff if you need to follow up with questions. So you can basically, a simple way to qualify a charity, look them up on the IRS website and they'll tell you, yep, they count. And at what tier can you donate to them? And we'll see there's different organizations, different organization types. How much you can deduct varies by the type of charity and the type of property given. So whether you give it to a public or private charity or whether you receive value in return. We'll talk about ways to receive value in return for your gifts. You know, if I donate, $10,000 to Calvary and Randy says, hey, since you can't afford your mortgage this month, you can sleep on the floor, then I might have to count the lodging value of my of my stay. Yeah, there we go. Good. And so any economic value I receive in return is obviously not tax exempt, and there's ways that works, and it can be a pretty straightforward and also can be a complicated calculation depending on how it works, but we can help you figure that out. There are two types of gains, short-term gains and long-term gains. When you make money, a profit on a transaction in less than a month or a year, that's a short-term gain. If you've held the property more than a year before you sell at a gain, that's a long-term gain. Short-term gains are taxed as ordinary income, just like my wages or a withdrawal from my IRA. A long-term gain pays capital gains income, which is a more favorable tax rate. So when you hear Warren Buffett say, hey, my tax rate's lower than my secretary, well, it's not because he makes less money than his secretary. It's because all of his income, or a big chunk of it, is long-term capital gains if he needs money, which is capped at, like 20%. And so he never pays over a 20% tax rate if he sells a little Berkshire stock to meet his ends. Of course, old Warren, he pretty much never sells any Berkshire stock either. But if he does, that's why, because it's capital gains income. Same reason you look at CEOs like Apple's Steve Jobs, kind of had this reputation of being just so virtuous because he never took a salary from Apple, right? He was only compensated in company stock. You know, from what I hear, backdated options where later they would pick what date that was. But why would I want it all in company stock? Well, if I get company stock, I sell it at a gain. That's far cheaper income tax than a big old multi-million-dollar salary, isn't it? So maybe it wasn't all out of the benevolence of his heart and the greater good of Apple. But he's not around to defend himself anymore, so probably not fair, right? Okay, the fair market value of property is the deductible contribution amount. We'll abbreviate it FMV, or when you see FMV, that's what it means, fair market value. You can gift almost any type of property. I know from working, with the deacon board and that at our church that some gifts, we weren't too sure if they were a gift or a curse. So, it's if somebody gifted us a rundown vehicle, we were hesitant to put somebody in it if we hadn't put more money into it to make sure we thought it would get them down the road a little ways, right? So we don't want to gift them a liability. So, when you are planning gifts, it's nice to be considerate. But some of the donor-advised fund companies that we work with are well equipped to liquidate that kind of stuff. And so you can give that kind of clunker to them, and they'll get it sold off, turn it back into useful cash, and then you can get it dispersed to the charities. So that way, Randy and team doesn't have to figure out what to do with that clunker.
Randy's done that a whole lot in my 25 years here.
You know?
With cars.
Yep, cars. We've seen it with real estate too, where sometimes you had to put more money into it than it's worth almost, before you could consider leasing it to someone or selling it in good conscience to
Well, a lot of
someone.
the vehicles I got didn't even run.
Yeah, exactly.
So I would just call a salvage guy and he
Right.
would pay me a certain amount of money,
Right.
and we just used that as a cash receipt for the person who
Yeah,
donated.
that's true. That's true. And there are some other valuations that the IRS sets forth where you might be able to get that donor might be able to count that vehicle as worth more than the scrap you got.
Usually
and,
not.
Yeah. And now scrap prices lately have gotten a little
Well,
better.
that's
So,
true,
but yes, you got to work on it, and you can't do necessarily much with it if it doesn't run. So, but there are institutions that can handle that. You've got some experience, so you know what I'm talking about.
Yep.
Some properties can require an appraisal for fair market value. If I made a gift of real estate, I need an appraisal
Yeah.
to say what it's worth, what I'm going to
Well,
deduct.
that even works with a vehicle. If a vehicle is
Yeah.
out greater value
That's
than
right.
5,000,
Yep.
then we have to have it.
You have to get it appraised.
Yeah.
Yeah. Where, who would you use for that kind of appraisal? Would you?
I go to a dealership usually.
Okay. Kind of get a private
They
sell
will give
quote.
me an appraiser.
Yep.
Appraisal quote,
Nice.
yeah.
I don't think that's in the presentation, so that's good to know, Randy. I appreciate your experience in that regard. Do not overstate the fair market value of your donated property.
That's for sure.
The IRS giveth,
they take
and if you lie, the IRS taketh twice as much or more away, right? And that's really what you see here. They'll take 1.5 times. If you overstate the value of the property greater than 150%, not only do you lose the deduction, you pay an additional 20% tax for the overstatement. If you overstate more than 200%, it's a 40% penalty. So they make those things punitive to where it's just frankly not worth doing. There is a publication, 561, that gives you guidance in determining the value of all kinds of different property you would donate. So I know they've set forth some things as far as valuing, vehicles and valuing like bags of clothing and that. Like once I learned how the IRS valued bags of clothing, that was the end of garage sales for me. Take them to Goodwill. It's like, you mean a trash bag full of clothes is worth X number of dollars? I don't remember off the top of my head how many dollars it is, but it's way more than I'd get at a garage sale.
Yeah.
Right? At a garage sale, you put a nickel on it, and everybody has to talk you down to a penny. I mean, nobody can just pay the list price at a
So you
garage
put
sale.
$100 on it.
Yeah, even though it's priced to move to begin with, So the IRS gives me, I don't know, say it's $25 a bag. I told my wife, I said, you got to start just giving that to a charity that accepts clothing donations. Take the receipt, and we'll take it off on our taxes. We'll get more than we will at a garage sale. So something to think about. I'm sure you'd really appreciate it if people don't drop off bags of clothes here. Though.
We really would.
All right. Unless they're bags of sports team uniforms that
Right.
you need. New
And
ones,
they're
preferably.
brand new.
Yeah, that'd be perfect. So planned giving can help you move your charitable deductions above the line. Deductibility could exceed 50% of taxable income in a select few circumstances. We'll talk about those. And I'd mentioned before that if you give property that exceeds that deductibility threshold for a year, you can carry over the deduction into future years, up to 5 years. So anything you can't take, if I had that 50,000 earnings and I made a $100,000 gift and I could only deduct 25,000 this year, I can deduct that 25,000 for 4 years until I've used the whole 100,000 deduction. So you can deduct up to 5 years. You can't take it further than that. So part of the planning too is looking at, well, how much am I going to be able to utilize? And I might need to pace it a little bit if maximizing my deductions is a big concern, right? If it's not, then you just say, okay, well, it's nice I get tax subsidized, but that's not the main reason I'm doing it. And we'll talk about later when the charities need money. Now, there is an exception, what's called a qualified conservation contribution, or QCC for short. These are basically donations of land for conservation purposes. Although I did notice they have a variety that you would think of, things with natural beauty, etc. But things like farm ground did fit in there as well.
I
So
would prefer deer hunting ground, but that's
that definitely counts as conservation ground
yeah,
right there.
Exactly.
Yep. And so because that can be much more valuable, they get up to 15 years to deduct it. And it's not in this presentation, but ranchers may be able to get 100% deduction on a QCC donation. So due to the nature of their livelihood. So a carryover contribution, when you do carry it over, if the tax rules change, it's going to be based on the deductibility threshold in the year that you gave the gift. Okay, so you don't have to worry about that ball moving on you and suddenly, oh, I thought I'd be able to use this 3 years from now, and you change the rules, which definitely does happen. And you deduct those contributions only after deducting all your current year contributions. So, I give a set amount per year. I still had some carryovers. I've got to use what I gave this year before I use my carryovers. If you have carryovers from 2 or more prior years, basically use the oldest one first, which makes sense because it will expire first anyways. But the rule is you have to. Okay, so that is about why to give. Who can give? Anyone. Anyone can donate. Individuals, legal entities. Legal entities can be corporations, LLCs, partnerships, trusts, not-for-profit organizations. Who can deduct charitable contributions? Anyone, and by anyone we're considering these entities as a person as well. Any person or entity with taxable income can donate. So yes, you too can donate. All right. And where to give. Understanding qualified organizations. So, a qualified tax-exempt organization defined by the IRS says you can deduct your contributions only if you make them to a qualified organization. How do you check whether an organization is qualified? I showed you that tool earlier, the tax-exempt organization search tool on the IRS website. Will show you that the IRS considers them a tax-exempt organization. Generally, so it says ask or check. You can ask the organization. They normally know. Still not a bad idea to check, right? Just to make sure that what they told you is accurate, right? Just like everything else, when money's involved, fraud gets involved too. And it can be pretty big when it comes to preying on people and preying on their kindness. Okay. So, in this case, I went ahead and I looked up Calvary on there. Good news, you are a tax-exempt organization according to the IRS. Yep.
Good to know.
Yeah.
So, good news for I saw you last at the President's Dinner. Good news for everybody that was at the President's Dinner that helped support. And you are in the deductibility code PC, which we're going to talk about here in a moment, the codes that it assigns. But one thing you're going to need to know for your deductibility is what code you're under by the IRS, and that you can find on here. And that your charity may know or they may not know, right? So deductibility codes, here's your cheat sheet if you need it. PC is the first one. PC is short for public charity. Good news is you're a 50% organization, and for cash is up to 60%. So the highest deductibility goes to these, and so normally we'll call them 50% organizations and 30% organizations. Essentially, public charities are 50% organizations and private charities are 30% organizations. In other words, they don't serve the general public, even though they may be a nonprofit. Okay, so a different type of 501c organization. You can see like a lodge in this instance, code counts as a 30% organization. You know, things like a domestic fraternal society, so the Moose Lodge, you know, from the Flintstones, that would be a, or was it the Water Buffalo Lodge? I think they were Water Buffalo, right? The Water Buffalo Lodge would be a 30% organization. There are SOs, supporting organizations, things like the United Way would be a supporting organization, right? A non-functionally integrated type 3 supporting organization. Basically, you know, looking at a supporting or operating organization or non-operating organization. Those are ones that operate a charity or operate have an operation. They have a shelter or they have whatever it is. Versus a non-operating would be like the donor advised fund. It doesn't administer an operation itself. It sends money to operating charities. Right, so you'll see that terminology, operating and non-operating foundation. For the most part, you know, we're going to be looking at these first three, PC, PCF, PF type, PC being the most common, being the one that Calvary is. There are two types of nonprofit entities, as we talked about, the public and the private. And so the public ones operate for the good of the general public. You have the 50% deductibility. That's that percentage of your AGI that you can deduct up to. There's 30% limit for capital gains, 60% for cash, and 20 to 30% limit for the use of contributions. Okay, so these are where we haven't given title over to it, but we've given, you know, maybe a contract for use, you know, a permanent agreement for use of the facility. So if somebody owned a piece of real estate, they signed a, you know, essentially permanent contract with you that said you can use this as long as you need. That's a for the use of contribution. The title didn't actually change hands, but the use of it did. 30% limit organizations also have lower limits for long-term capital gains at 20%. Okay. So public nonprofit examples, we won't go painstakingly through these. You know, the top 3 or 4 are probably the most common. Churches and conventions or associations of churches, educational organizations with regular facility and curriculum, regularly enrolled student body attending classes on site, hospitals, certain medical research organizations associated with hospitals, organizations that are operated to hold, invest, receive, and administer property, make expenses for state and municipal colleges. One that kind of surprised me, I guess it's not too surprising, number 5, the United States, the District of Columbia, a U.S. possession, a political division of a state or U.S. possessions, or an Indian tribal government also count as nonprofit organizations. So if you feel like you haven't given enough to the government, you can give additional, and that counts as a donation or a deduction. So
Trump talked about that today, I think. That
Yeah.
somebody was willing to
give money to pay down the debt.
no, not to pay
Oh,
down
okay.
the debt, but to pay the military.
I heard about that. Yeah.
He said
And
he had a donor that was going to give massive amount of money to help pay for the salaries of the military and different parts of the government people.
that seems like a wise investment.
Yeah.
Yeah, I called that always got me when they hit the debt ceiling, you know, and they would stop paying the military was one of the first, deployed military,
Right, yeah.
stop paying them was one of the first things that they would do.
Yeah.
It's like, I think we could fix it if we did it the other way, if we stopped paying Congress until it was fixed.
Yeah.
And
There
you
you go.
paid the military no matter what. In fact, that's the only constitutional expenditure we probably have for the most part in the federal government is paying our military, right? So, yeah, it's absurd. But I bet they'd get this debt ceiling stuff worked out real quick if they weren't
Yeah,
getting a
oh, yeah.
paycheck till it was done. So anyhow, but
And some of them are doing that now, I heard today.
yeah,
Giving up their salaries.
that's a good thing to do.
Guaranteed there's one party that won't.
That's right.
We won't talk about that.
That's right. That's right. And then there are other public supported charities, and there are more nonprofits. The 7, 8, 9, 10, 11. I'm not going to read them all to you because they're kind of painful if we read them all. But basically, most of these, as you can kind of see in 7, is kind of notable. It says organizations that basically support 1 through 6, for instance. You know, I don't know why we need that, but obviously it's come up. And here you do see the operating foundations and non-operating foundations. So those are pretty obscure. Private nonprofit examples. We've got private foundations. We've got lodges, which we talked about briefly, and lodges also including type of qualified organization, not in the first category. Let's see, stewarding your gifts. So, if your charity is inefficient, you might be shocked how little of your contribution directly benefits the cause you intended to support. This is important as a steward of my giving. Not all giving is equal or equally beneficial, right? And if we're going to be wise, we need to be wise about how they use the money. And when I first learned about this, I had a number of family members who were fighting cancer, and one was my aunt. And I was looking to help raise some money to give to a cancer research organization. And, you know, we'll talk about some tools that I used. In fact, okay, it's on here, charitywatch.org. I'm not sure if you're familiar with them, but if not, it's a nonprofit. And their job is to help you vet nonprofits. So they go through those tax filings, and if they see questionable things, they reach out and request information, and they break out, you know, how much goes to fundraising, how much goes to executive salaries, how much money are you just sitting on, you know, all these different things. And then if they have some concerns, they'll reach out. And if they don't get commentary back for their concerns, they'll let you know about that as well. And they'll grade the charities on their efficiency. And so it's a good tool for helping to vet organizations that you may not be too familiar with, or they called you on the phone and you're thinking about giving to them. And what I found in her case was, you know, a popular one at the time was the Susan G. Komen Breast Cancer Foundation. And when I looked it up, I was a little dismayed at how inefficient the organization was. And thanks to them, I found the Cancer Research Institute, who was much more efficient, and I liked the work that they were doing. And so we chose to support that. And this tool helped me to parse that and identify a charity I wanted to help raise money for versus one I really didn't after looking at it. And so some of the most prominent ones can be the worst stewards, the biggest names that you've heard.
Right.
Why? It's kind of like a lot of businesses, you know, like the number one insurance company you see advertising doesn't necessarily make it the best insurance company. It's the one spending the most money on marketing. Well, where's that money come from? Premiums, right? So they don't get any money you don't give to them, right?
Red
So,
Cross is one of the worst.
yeah, exactly. And part of why this happens, and I talked about, you know, where there's benevolence and where there's money, there gets to be more fraud, right? And here's part of why somebody interested in that would look at this and say, oh, well, did you know the government's prohibited from creating laws that limit charity overhead spending? Overhead is what? When you hear the term overhead in business, what's that mean? Those are your fixed costs, basically your business costs, your business expenses. Okay? Well, what kinds of things go in business expenses? Well, rent and lights and water and pension contributions and salaries and bonuses, right? So a charity that is legitimate, according to the IRS, has to meet one guideline. They can spend up to 99% of your donation on overhead expenses. So they have to have at least 1% of the money that comes in gets to the cause at the end of the day. That's a pretty low bar, and you can
Yeah.
see where that would be appealing if you are good at convincing people to give you money,
Yeah.
right? I'm not sure how legible that slide is for you from there, but
It's like going to the eye doctor, man.
yeah, I know. I even tried to blow it up. This was about as big as I could get it, still get it on the slide. So you've got a handout you can pull out for that. And even then, it's a little. But this came from CharityWatch.org, a list of the highest paid CEOs in charities. And number one on the list, we have Memorial Sloan Kettering Cancer Center, $5.8 million compensation. Includes $2.5 million basically of bonuses and incentives. We have Mr. Stone from City Hope and Affiliates, $5.46 million. We have Catherine Martin from Sloan Kettering Cancer Center. That's two of them, actually, from the same place. $4.7 million. The American Heart Association. Speaking of prominent names.
Yeah.
We used to jump a lot of ropes when I was a kid for the American Heart Association, and obviously we needed to because Nancy is due $4.4 million. And then Jason Klein, another one from the Memorial Sloan Kettering Cancer Center. 3 of the top 5 work for one organization, $3.5 million. It's hard for me to think of working for a nonprofit firm and having a heart for a cause and saying, yeah, but you really do need to give me $3 or $4 million bucks. I mean, my time is valuable, you know. And I'm overseeing a big budget, right? These are the kind of things that justify it. You know, I'm running this big corporation. Look at what people running big corporations get paid. Yeah, but they're running for-profit organizations. They're not trying to, any money that goes to the staff doesn't go to the cause, right? So do you care about the cause or do you care about yourself? I don't know. Maybe they're earning every penny of it. But it's something to pay attention to. So a stewardship comparison. This was an example of what I found from Charity Watch when I was doing my research. And we see the American Breast Cancer Foundation gets an F grade according to Charity Watch. Why? Well, only 26% or 26 cents for every dollar that's donated to them gets to the cause. Right? The rest goes to overhead. And the cost to raise $100 is also interesting. For every $100 given, $85 goes out to get people to send them $100. Right?
Yeah.
So most of what you're sending is just postage if you're sending to an organization like that, right? And versus the Cancer Research Institute was the one we ended up choosing when I was looking for a cancer supporting organization. They get an A according to Charity Watch. 86% of what they collect, just basically the inverse, goes to the research. And only $12 of every $100 raised, or 12% cost for the fundraising. So, yeah, big difference, right? And CharityWatch.org, you can use the resource for free. They usually ask you to, give them some. I think 50 is kind of the recommended minimum. You can use it for a year, be logged in as a member, get access to more data. You can see select data free. But if you pay the $50 a year membership, you get all the access to it. And that's what I'm happy to use because it helps me steward my gift. And helps. And by the way, I pay for it, so if you do need a report on something, if you want, you could reach out and we could help you if there's something you're looking for. But if you call every week, I might say, do you got $50? You might want to just give it to Charity Watch and I'll give you the site. Good. All right,
Does
so.
anybody need any bottles of water? We got bottles of water or stuff over there.
Yeah,
So help yourself.
probably should take a drink of water here. Okay, good. So, what to give? Time, talent, treasure, the 3 T's. We had the 6 W's, these are the 3 T's, right? It has to be treasure, not money, because money doesn't start with a T, right? So I'm just kind of idiosyncratic that way. All right, so time. Time is the ultimate commodity, really. Time is the one you can't buy, you can't make. You can't buy time for you anyways. Now you can buy other people's time. And one of the things I teach my retirees is, hey, You know, should you manage your stock portfolio, or should you bounce your grandkids on your knee? Right? Nobody I've met yet, when I hear about their regrets in life, tells me, man, I wish I spent some more time in the office. Man, I wish I spent some more time working on my investments. You know, their regrets are different. You know, and I think about at the end of my days, if somebody was sitting there with a big roll of time, and for me, they're Saturday mornings. Saturday morning's my favorite time because I get up, have a nice, it's the one day a week that I used to get to sleep in. I don't get to sleep in anymore with my kids and my wife. Even if I don't have to go to work, they make sure I'm not over resting. But I get up. I love breakfast. There's only one day a week, really, that I get to eat a real good breakfast. You know, Saturday morning, get up, have breakfast, drink coffee, play with the kids, hang out with my wife, relax, right? Only day I don't have somewhere to be generally early in the morning. And so I love it. Well, if they're sitting there and they're saying, Isaac, I can sell you Saturday mornings by the hour with your kids at the end of my days, what would I pay? I'd be like, here's all my accounts. How much does that give me? Right? So you cannot buy that. You have to value it. But because it's so valuable, it's one of the greatest gifts you can give to a charity. Right? Your time and your energy are things that cost them. So how do we donate our time? We can serve on boards, work for committees, contribute wisdom to the organization, provide advice, mentor others, right? Your talent, your human capital boosts the charity's limited resources. One thing I can tell you from business, the most expensive thing in my business is the people, right? By far. And so if you can help a charity need less people that it has to put on the payroll, you're making a big difference for that organization. What are some things that we could do? We can contribute manual labor. I might not be good for much, but I got arms and legs that work and I can carry some stuff for you, then that's a skill, right? We can put you to work on some things. Especially at today's labor rates. You know, last time I had a plumber in, he charged me $150 an hour. I immediately went to the office the next day and raised my hourly rate because that's what I was charging.
Yeah.
I said, well, if you're $150, I guess I'm $250 now. You know, I'm supposed to be a professional. Anyhow, technical skills. You know, we may have particular technologies like the gentleman you spoke with helping get the recording and the computer ready. You know, he's maybe an employee, maybe a volunteer, but if somebody has those skills and they can volunteer and help, that's valuable for your organization. Creative skills. Most nonprofit organizations have somebody in the group who's a pretty good artist, a good videographer, a good photographer, good at drawing. They can help you with your marketing materials. Professional services. This is where I come in. I know about finance. So I apply those expertise in my church. I help them with budgets, help them with I'm not the treasurer, my father is actually, but help them with their budgets for the mission committee and for the annual church budget, right? And help them get their insurance and retirement programs in line. Come here and help teach you guys this stuff. Tax, legal, you may have accountants, lawyers, doctors in the organization. They can all make contributions that save members or save the organization a lot of money. Risk management, a fancy word for insurance. Let's see. Treasure, your liquid assets. Could be money. There's various types of money. What I call soft currency. Those are the paper dollars that we usually carry in our wallet or in our bank account. Those might be digital dollars. There's hard currency, gold and silver, those things. You can't print more of them. You can dig for them. That's about it. And then cryptocurrency, which they now mint digitally. And those are all forms of money. All could be donated. I don't know if Calvary wants cryptocurrency, but you got to find a way to liquidate it, right? Yep. But there's definitely people with a lot of unrealized gains in their cryptocurrencies right now, right? So those are all different types of money, some that we don't normally think of. Securities. Securities basically is another fancy word, but essentially it means stocks, bonds, mutual funds, things that fluctuate in value, that investors subject to risk in order to obtain returns or to pursue returns. So you can give those to nonprofit organizations. You can give them without selling them. And the way they can receive them, I don't know, Randy, have you ever had a gift of stock?
Yeah,
Yeah.
once
So,
or twice a year.
yeah, you got to update, either if they've got directly held stock, you got to update the certificate owner registration, or if you've got an account,
Yeah.
then they can transfer digitally those shares right into your account, and that's how that gift is made. Let's see, contracts. So you can transfer annuities, life insurance, and trust to charities. There are hard assets, right? These are illiquid. Not that they can't be sold. They're harder to sell, maybe more expensive to sell. Real estate, commodities. You probably don't want any oil barrels, but that would count. We could get whatever, $67 a barrel and roll some West Texas crude in here, right? You'd find a way to get rid of it, I trust, Randy. You'd have to call Exxon or somebody. You'd find a way. So maybe they have that. Commodities could be crops and things like that as well.
We had a cow
Gold
calf.
bars.
We used to have a cow-calf program,
Yeah,
and that worked quite well.
yeah,
for a few years.
absolutely. Absolutely, yeah, it's things people don't always think about, those things. Personal property, clothing, collections, household goods, artwork, and commercial property. Could be business interests, a share of a partnership that I own. I could transfer it to your organization. I might have a patent that's worth money. I could transfer that to your organization. You receive a royalty from it. I might have inventory in my business that I didn't sell or I don't want to mark down too far. Maybe it's worth more as a donation. So those are all things that we could give out of treasure that are hard assets. So, when to give. Timing your charitable contributions. When does your favorite nonprofit organization need money?
Always,
Yep, you got it. Now,
now, later.
now, and later. That's right.
Or just always. You can cut that down.
You're right, I could truncate this. I've been looking for edits. That's one, all the time.
All the time.
Uh-huh. I didn't put animations in, but I thought I'd put the now and maybe animate the and later in there too. A bit of a joke. I like to have a little humor because when we talk tax, we talk all this stuff, it can get a little dry if we don't have a little entertainment with it, right? But yeah, in other words, they always need it. But a big capitalized now, because money now is always better than money later. And the bills are here now, and if we don't pay the bills now, we won't be here later to receive the later donations. So, now is the time to give. When we're giving now, they could be gifts, routine gifts from regular earnings. They could be intermittent gifts from windfalls. You know, I got a tax return, I sold some property, I got an inheritance, all those kind of things. I won the lottery. With that, the windfall gifts, lumping can improve tax efficiency, so that could allow us to move more money now and then take our tax advantages over the course of several years. Donor advised funds, as we talk about, can give you the ability to say, hey, I know what I want to give, I know how big of a deduction I want, I don't know where all I want it to go. It's a lot of money, I'm not sure what I want to do with it. You can have all the time in the world, but you can take your deduction now using a fund like that. You can gift appreciated assets that you don't sell due to tax liability. Working in the wealth management business, I work with a lot of people that have stuff that they literally hold on to because they don't want to pay the taxes. They've made good money, they pay a lot of taxes, they hate paying taxes. If there's anything, they'd rather lose money on the investment than pay more taxes. Right? Well, what if we could show you how to have your cake and eat it too? Say you're already charitably inclined, you have these appreciated assets, you even give money to the charity already. Are you doing it as efficiently as possible? What if we could gift that Apple stock over rather than pay gains on all of that, and then you keep more of your after-tax money from your regular paycheck? So, nonprofits can sell that property at zero tax liability. It's a really powerful concept when it comes to your tax planning, when it comes to defunding the enemy. My experience, I'd say your favorite charity will forgive you if you were to give them $50,000 now instead of $5,000 later each year for the next 10 years.
Amen.
Yep, because they need it now. Contributions do have to actually be paid in cash or other property before the close of that tax year. So signing a pledge saying I was going to give $50K doesn't give me the deduction this year. That money needs to be in their hands by 12/31 of the tax year. Later. As we said, need it later also, right? What are some ways we can give later? They do depend on your giving now, but what happens to their work when you can't give later? A big problem churches are facing everywhere, right? We've got generations prior, the church was very important. They're good support, or is very important. They're good supporters, good donors, very reliable. They're the backbone of their churches. And you've got sometimes less and less young people coming in, or less and less inclined to charity and civic duty. Those type of ideas are less prominent in some of these younger folks. I like to say I've never seen more people care more and do less about it, right? Posting a sign on Facebook is not making a difference. Donating your time, talent, and treasure that actually cost you, that makes a difference, right? And so there's real loss that happens when I lose a longtime supporter in an organization. We have to replace that gift. So just like I think about how do I take care of my family when I'm gone, what about my church family? What about my Calvary family, right? How do I continue to provide for them? So, you can help reduce hardship from loss of longtime supporters by leaving part of your estate to a charity. You can do it through a will, trust, or beneficiary designation, sometimes called a TOD or a POD designation. That can accomplish it for unused assets. Pretty simple. I want to leave this bank account to my church when I die. Put their name on the beneficiary. It's done. When you die, let them know so they know to go and claim it. When you die, they come in with a death certificate, proof of identity, and a PIN, and it's theirs. So it doesn't have to be complicated. It can be. And the nice part about remainder planning or estate planning is that once we pass, we know we're done with the money.
Yeah.
Funny thing
Right?
about that, yeah.
My clients who are retired and who are aging are sitting on money I know they're not going to use in their lifetime. You know why? Because they've still got it, and they've had it for 20 years, and it's just growing. It's growing, and they're not spending it. And we're having conversations about somebody else is going to spend all this. You need to do something with it. But a tiger doesn't change their stripes, right? They've been a saver their whole life. They don't suddenly turn into a spender. And there's going to be an even bigger pile when they're gone. And they might want to leave some to the kids, but do the kids need $1 million or $2 million? Not necessarily. Maybe it's not even good for the kids. Maybe it'll only hurt them. And so they can leave that money, but they're sitting on it because they have these boogeymen,
Yeah,
right?
that's right.
The big boogeyman is healthcare. It's a nameless, faceless monster that lurks around the corner. I don't know what he's going to take, so I just hold the biggest pile of money I can think of to hopefully I have enough. Well, the good part is if you work with a planner, I can put a name and a face on the boogeyman. I can tell you on average how tall he is, how much he weighs, what he's going to take every year, how many years you're going to deal with him, all that stuff, so that you can start to say, okay, this is my little boogeyman fund. This is money I probably don't even need even if the boogeyman shows up. Well, now I can do something with that, right? Or we can do other things. We can have long-term medical care insurance and things like that that help with some of those costs. So a lot of times there's just these fears that we can't put a name or a face to, and so we're just sitting on this money, afraid that what's going to happen if we don't have it, right? So we can do some planning. So who does better with the remainder? If you do have $500,000 or $1 million estate, who's going to do better with it? your favorite charity, or the kids or the grandkids. You know, or if you don't have a good trust or something like that, it might be your least favorite daughter-in-law and her new husband. Right? That's a shame. So, good ad for a trust, but also part of the importance of maybe leaving it to a charitable organization. And there are ways to still take care of the kids and that, and we'll talk about that as we go. Interesting fact, Kansas just passed a law. I need to double check Missouri whether they have the statute officially on the books. But this is something in that 9 years ago when I started thinking about it. I started calling insurance companies and saying, doesn't my church have an insurable interest in me? There's an old saying, an old kind of test that we use in the insurance industry to say whether somebody's got an insurable interest in the life of someone else. And it was, what was it? Blood, bucks, or business. Right? If we have a blood relationship, we have a financial relationship, or we have a business relationship, we have an insurable interest in one another. In other words, there is a harm that comes to me arising out of the loss of your life or someone's life. Then I have an insurable interest in that person. And I thought, well, if I'm given to my charity every pay period and then I die, they're losing money, aren't they? So they suffer a financial loss if they lose me, if I lose my life.
Right.
So don't they have an insurable interest in my life? Yeah. At that time, I found some of the more innovative insurance companies were saying, yeah, I get it, Isaac, totally, I agree. That's important because your underwriter has to agree if you want him to issue you a policy. Okay? But now Kansas passed a law. I think they heard I was starting these classes this year, and they passed a law, and they said, yes, nonprofits have an insurable interest in their donors. Real simple, too. One page, anybody can read it, understand it. So it's officially codified there in Kansas. I haven't double-checked the Missouri statutes to see if it's already codified there.
So it's just an insurance policy you buy? Then?
Yeah,
Is that what it
yeah,
is?
essentially. So you can't take out, for instance, life insurance on somebody that you don't know, right? Like I could have a neighbor who's aged, and I might say, you know, I bet I could pay the premium on that one a few years and, you know, collect a larger sum of money. Walmart had a little problem with this back in the day. They were taking out life policies they were hiring all these elderly people, making them janitors and stuff, and they were taking out life policies on all of them.
True story.
And they weren't telling them about it. And they weren't letting them pick the beneficiaries. The beneficiary was Walmart.
How could that be legal?
It's not.
Oh, okay.
The court decided it was not legal because they didn't have insurable interest.
Right.
And they didn't have permission to be the beneficiary of those policies. So if somebody's going to take a policy on you, you have to sign and consent to it. Like if you stand to benefit from me dying, it's good for me to know that.
Yeah.
Right? Pretty important. And that person has to be able to prove that there's a reason that I'm at a financial loss if you're no longer here.
Right.
We got to have that blood, bucks, or business relationship. That constitutes insurable interest. So I have insurable interest in my kids, for instance, because we're family, right? But I don't have insurable interest in my neighbor, right? And so I can't just try to profit on them being elderly and try to buy a policy and hope that they die soon enough that I don't pay more premium than I collect in death benefit. Okay. And there's kind of, you know, phenomenon now, investor-owned life insurance and stuff, where somebody bought a policy that had insurable interest, and then they can't afford the premiums anymore, and these investors come along and underwrite and say, how long are they going to make it? How much cash is that going to be? And that could be a pretty good ROI if they pass right in time. But that's really scary to me, because I really don't want a bunch of very wealthy people profiting if I don't make it very long. Just seems like a lot of bad things could potentially come from that.
Well, you'd always be looking over your shoulder.
Yeah, exactly. I feel like I would. I feel like if there's enough money involved, they'll make sure to get the ROI on that policy.
Yeah, it's about time.
So would that be like where the document you signed says I'm going to continue to give to Calvary?
Yeah.
I intend to give for the rest of my
Yeah.
life, and then Calvary then has the right to.
Right. So you'd
Take
want to
out.
have some records to demonstrate that Yeah, they've been a steady giver, of ours, and we've made whatever we'll talk about some of the agreements, that you can have. We've got an agreement with them that, maybe they made a gift to us, and we'll talk about this specifically in taking care of their heirs. Because what might be one reason I don't give you all my money from my estate? Well, what about my kids? Right? Well, you know what? If your main concern is giving money to your kids when you die, there's a real good way to do that that's much more tax efficient than leaving them a big old IRA. And that's leaving a life insurance policy. Right? So we might have an agreement. I'm going to make a large gift to the charity, but I'm going to need some money to fund a life insurance policy. Okay? So then you get a policy that pays my children. Okay? And so the children are taken care of and the charity gets to keep the change. And so those are some of the concepts that we'll talk about. But yeah, it shouldn't be, and they don't scrutinize too closely. Some of the carriers will, but they will ask underwriting questions in the application. What's your relationship to this person? And they're looking for that because they also do not want people to die before life expectancy. And so they'll try to prevent that if they can. And so we had now, later, and both, right? You're all the time, as you said. So, gift today, remainder gift tomorrow from my estate. This brings in concepts like the charitable remainder trusts and the charitable gift annuities. Even a charitable gift annuity is essentially about the same as a charitable remainder trust, just a little bit different vehicle. And what's a charitable remainder trust, or CRT for short, is an irrevocable trust. It lets you donate assets to a charity and draw an annual income, commonly for life, maybe for a fixed number of years. That fixed number of years cannot exceed 20 years if it is a fixed number of years. If it's a life payout, it could exceed 20 years, if I exceed 20 years, right? But if you pick a set number of year payout, then you can't stretch it past 20 years. Why would somebody want to do that? Well, when they're getting a benefit from it, what's another reason I might want my money? Well, I'm worried about my expenses. I live on the interest. Well, what if I could get an income still from that asset? Okay, enter charitable remainder gift planning, right? The charity will send me a gift or a allowance, a payment every year. And if I gave them, say, some highly appreciated property, they can sell it, not pay taxes. If I sold it, I'd lose a quarter or a third or a half of it to tax. They can sell it tax-free, and then they can give me some benefit. Maybe I was taking some dividends off of that stock and living on them. Then maybe they can continue to send me a payment similar to what my dividend was. And rather than have to claim all those capital gains in 1 year, I only claim a little bit of income from that trust every year, and I spread that tax liability out over a decade or more rather than realizing it all in one tax year. So it's a pretty powerful concept. And we're going to start talking about some of those concepts in how to give. And so here we're looking at how to apply financial planning to charitable giving. And so I think that a lot of people talk about some of these concepts. And I know, and you guys can probably tell me even better, because I've talked to a couple of them who work and do these sort of things in terms of gift fundraising consulting and things like that, where they come to the charitable organization and say, hey, let me show you how to send a better mailer. Let me show you how to host a better dinner. And they charge a fee for that typically, right? And so I'm kind of the mind that I think maybe there's a better way, that I don't want to come to nonprofit organizations and say, hey, you need more money. The key is you're not giving me enough money. Give me more money, and then more money will come to you.
Right.
And I know from business, mailers don't do a whole lot. There's not an invitation that makes money rain from the sky. All those things. There are a select few things that are effective. And I do believe that largely people just need better information, and they need to understand their options, right? And a lot of people who do have these pains, like, yeah, I'd love to sell that stock, but I don't want to pay the taxes. And by the way, I believe and support these charities. I have charitable intent. If we can show them more powerful ways to leverage tax code, their gifts, and these other financial planning tools, that they can make more impactful gifts more quickly and be a great benefit to both. And so what I think lacks is that a lot of these organizations, they don't know how to put together the products and the tools that we can use to do the planning part, because they're not financial experts. And so that's what this section pertains to. And so, income. Routine support, paid as earned. It counts as income when you receive it, and when you donate it, it counts as a deduction, commonly in the same year. Income can be earned, or my personal favorite, unearned, right? Doesn't mean undeserved. Unearned means passive, right? Money you don't work for. If I've got an investment and it's appreciating, or it's paying me a dividend, or I've got a pension and it's sending me a check, it doesn't count as earned income. So think of the real distinction is work from wages or profit from self-employment versus all the other types of income. Your interest on a CD is unearned income. Okay, so passive, like interest from interest, annuities, or dividends, are unearned income. It can include pensions, Social Security, things like that we talked about. Gifts can be automatic or manual. You might have an automatic deduction go into your charity, or you might write a check and send it in or drop it off. Or bring in those soft dollars and plop them on the desk there. Routine income is very valuable for charities budgeting, right? They are a business. The bills are routine, are they not? The lights keep coming. The water, sewer, trash keeps coming every month. We need the money to keep coming every month. So just like for you in your household, regular income is real important. It is for the charities that you support as well. So giving from income routinely is very important. There's lump sums. One thing I've learned in financial planning, and I've looked at it in many scenarios to reevaluate it, and there's one truth that I've found, and that is that money today is always better than money tomorrow. Time value of money, they'll call it in our world, but larger contributions made earlier are more impactful than money over time. Even that example of $50,000 up front or $5,000 a year for 10 years, they're both $50,000, but they are not worth the same over 10 years. Right? Just simply that the money today could be earning money. If I didn't need it, I could be making interest on it for the next 10 years while I'm dispersing it at $5,000 a year to fund the cause. So big gifts make big impact, right? And some of your supporters may want to make a big impact. They all want to make an impact. That's why they support. So larger contributions also from the personal standpoint can help you itemize deductions and help you realize the tax advantages of your support. Some lump sum gifts could be an estate. They could be an endowment or a donor fund, a trust, an annuity, low yielding cash. Kind of an interesting to think about with cash, especially when rates are low. But if you look at your tax rate, it might be a 22% tax rate, right? And you might be making 1% on your checking account. If that's a pretty rich checking account. I work in banking. I like to say with like an interest-bearing checking account, I call it just enough interest legally to call it interest. 0.01%, 0.05%. Realizing that 1% is 100th of a dollar, 0.01 is a 10,000th of a dollar, right? So, but yes, it pays interest. Well, what if I can give that money? I could get maybe a 12% return on my tax return this year, or I could get a 22% return from the IRS this year by giving that money, right? Of course, you need to have some left in your checking, right? But one way I can improve the return on all the money would be to give away part of it. So what is the financial benefit of a gift like that? Let's see, before tax. So we can give before tax or after tax. If we give before tax, things like a deduction by a business. We talked about all the business expenses are above the line expenses, or they itemize everything. A C Corp can deduct 10% of taxable income. So they can't give it all away and write it all off, but they can give up to a tenth of their profit, essentially, per year, and deduct it. They could give more than a tenth of their profit, and then they just carry that forward like you or I would for up to 5 more years. So you have and by the way, on the carry forward, it's the year of donation and then 5 years following. So 6 years of deductions altogether. A pass-through entity, Frank, you'd asked about sole proprietors, or S Corp is another form of a sole proprietor. It's a corporation, but it taxes everything at the individual rate, passes it through, it's called. Partnerships are passing through to the owner's personal return. So all the income is passing through the profit or loss from a sole prop or a S Corp or a partnership. And so the deductibility of contributions will be done on the personal return as well. So the owner must itemize deductions. And let's see, charitable deduction is subject to individual AGI limits versus the 10% of taxable income for the corp. And then we're going to spend some time on what's called a qualified charitable contribution. This is a really powerful tool in the revenue code that a lot of people still are not really aware of. They go by QCD for short. And a QCD, meaning qualified charitable distribution, is an otherwise taxable distribution from your IRA owned by an individual aged 70 and a half or older that is paid directly from the IRA to a qualified charity. Okay? Why 70 and a half? Well, you may or may not remember that there was a required minimum distribution from IRAs, and the rule was you had to start them at the year you turned 70 and a half. You had to distribute part of your IRA by the end of the year that you turned 70 and a half. Well, that rule has changed. It's 73 now. But this rule has not changed. And I just reconfirmed this month that it still is 70 and a half, because I was thinking, did they move it? Nope. And they probably won't. Maybe one day they'll look and say, was the intent of it to match the RMD age or not? But there are some people who are in between where those laws changed, did start them at 70 and a half, and maybe they're 72 now. They have to continue them if they had already started them under the old laws, so that may be part of why it's set this way. So if you're 70 and a half or over and you have an IRA, you can use this. If you have a retirement account that's not in an IRA, you can put it in an IRA and you can use this. So qualified charitable distributions count toward your required minimum distribution, or RMD for short. You report the full amount of the charitable distribution on the line of your tax return for IRA distributions, and you enter the full amount as the amount of the distribution, and then in the taxable amount you put 0. And they have a really fancy technique for claiming this. Next to it you write QCD in the margin of the 1040. I know, it's kind of absurd. You would think probably someday the form will update to have that, but for right now, that's the fancy way you do it. You tell them that you took it out, or you show that you took it out. You report claim 0 as taxable, and you make a note saying, hey, I gave it directly to a charity. Now, it's important that you do understand, because if you get it in your hand, which we'll talk about that situation, you could do this, but if you get it in your hand, I take a withdrawal, I get a check to me or a deposit to me, and then I turn around and write a check to the charity. That is not a qualified charitable distribution. That's a distribution and a charitable contribution. It's two separate things. And we'll talk about that. You can do that. If you're not 70 and a half, you might want to do that. But here, the IRA trustee writes the check directly to Calvary. My name is never on the check. That makes it a qualified charitable distribution. Part of why you have to claim it manually, your trustees are still going to send you a 1099 that says you had a taxable withdrawal. Why? They're not in the business of vetting 501c3s. They will leave that between you and the IRS, but if you tell them, pay a check to somebody else, they'll do it. Okay? So that's why you do this on your tax return. So if your accountant gets concerned about it, you need a new accountant. Or you can have your accountant call us and we'll explain how it works. Okay, so qualified charitable distribution, one-time election. There's a one-time distribution of up to $54,000 from an individual retirement account that can be paid to them through a charitable remainder trust or charitable gift annuity. So you can use up to $54,000 of a qualified charitable distribution to fund a remainder trust or a gift annuity where you then later are still receiving some income from it, right? So the IRS does put a limit on that because otherwise that'd be a lot of fun to just do a lot of it every year. Now, there's not a limit on how many total qualified charitable distributions you can do. And there is a limit on how much total you can do in a year, which is $100,000. So pretty good chunk that you can do that way. So in this case, this is a one-time feature where one time you can send up to $54,000 for 2025. That's been going up like $1,000 a year. You could send that to a charity through a charitable remainder trust or gift annuity, which could still give you some benefit. Tax deferred assets. These are things that I might want to donate because I have unrealized gains in them. They've increased in value. I haven't sold them, but if I do, I'm going to have to pay taxes on the difference in my cost basis. Cost basis is what I paid for something and the fair market value of it, or at least the sale price. If I sold it, I might not have sold it at fair market value, but that would be taxed as a gain. Things that would apply to property like real estate, collectibles, vehicles, commodities, bullion bars, those sort of things. We talked about securities, insurance contracts, and currencies. So all those things, you would claim the income when you sell them for more, hopefully, than what you paid for. Okay, if you sold them at a loss, you don't need a deduction. You actually get to claim the deduction. What you need is a better investment. Let's see, after tax. So you can gift these tax deferred assets pre-tax, right? You can gift them, the charity can sell them, and then they claim the income, but they pay no taxes on their income. You can also gift things that you've already paid taxes on, my wages, my realized gains, my business profits, depreciation recovery, which is kind of a nasty thing that happens when you sell real estate. If you've ever had investment property, you get this lovely thing called depreciation, right? I call it an accounting loss. 5% of what you paid for the rental property, you deduct against your income every year, depreciation on the real estate, and it shelters that cash flow. But the IRS giveth and the IRS taketh away. So whenever you do sell that property, they actually charge all that back to you as income at ordinary tax rates rather than long-term capital gains. Which is part of why the people sit on the property and never sell it, right? They don't want to pay that huge tax bill. Well, what if we can show them, hey, you can give it to the charity, we can sell it, pay no taxes, and we'll give you a little rent check the rest of your life as well because you were getting that from the property. That becomes pretty enticing to them. So, look at how to apply some of that, applying financial planning to nonprofit organizations using planned giving techniques. Transfer of assets. You can transfer assets to charity ownership by updating the registration. We talked about that. Basically, it's putting the title of the property from your name to the name of the charity. This could be done with investment accounts. It could be done with stock, vehicles, real estate, anything that basically has a title to it. Bank accounts could be in there. In real estate, could be a home, could be land, could be rental property, could be commercial, agricultural, or conservational ground. Good deer hunting ground, as you would say. Charitable remainder trust, what is it? It's an irrevocable trust, lets you donate assets to charity and draw annual income for life or a specific period of time. We talked about that briefly. How does it work? The donor transfers the property or assets into an irrevocable trust. Irrevocable is an important word. You can't undo it, right? Just like you can't take back your gift, to the charity. That's why you get to deduct it, because it's clear of you and there's no ability to reclaim it. The trust basis in transferred assets is the carryover basis. So what I paid for the assets that are in the trust when I transfer it is considered the cost for that property. And so if I have land that I had paid $1,000 an acre for, and now it's $11,000 an acre, and I put it into the trust costs will be considered to be the $1,000 that I paid. The $10,000 unrealized gain is still embedded in there. And then we transfer that stake in the trust to the charity. Now, the trust may continue to exist. Well, it does continue to exist, I should say. But part of the beauty of this is that the trust might benefit multiple charities, for instance. It remains like an asset held outside the charity for the benefit of the charity, right? And then when I'm done, the trust may be paying income, has to pay income to at least one living beneficiary. Could be more than one. So maybe I've got a large farm estate or agricultural estate, and I want to take care of my kids for a while or my grandkids for a while with it, and then I want the remainder to transfer to the charity whenever they pass away. You could use this for something like that. We talked about payments continue for a specific term, up to 20 years, or the life of one or more beneficiaries. No real stipulation on the age of the beneficiaries. It could be a grandchild. Say, I want them to get the income from the farm as long as they live, and then when they're gone, I want the farm to go to Calvary, for instance. Or I want it to go to 5 charities that I love. And after the payment term, the remainder of the trust passes to one or more qualified charities. There does have to be a remainder, at least a 10th remainder in these. So if I gave $1 million, there has to be at least 100,000 interest that transfers to the charity at the end of the term. Which is the next point. And then, as we said, they're irrevocable, so assets that go in can't be taken back. So why create one? It helps you plan larger donations to charities that you support. It can provide a predictable income for life or over a specific time period. So a lot of times if we're paying somebody for life, they might be getting a 5 or 6 or 7% distribution. And maybe that's what they were using the asset for, was to live on and get. They might have only been getting 3 or 4% interest payment on it. So now if they're getting 5 or 6 or 7% distribution from the trust, that's pretty good for their income, which was the thing they were worried about sitting on that asset, right? So that might unlock it for giving. They can defer the taxes on the sale of the assets transferred to the trust. You can pay a lower, if you're the grantor of the trust, the assets to the trust, you can pay a lower marginal tax rate due to lower income over multiple years instead of higher progressive tax in 1 year. I don't know if you're familiar with progressive taxation. That basically is the idea that the more money you make, the higher your tax bracket. It's not retroactive to the first dollar you make, right? Everybody pays the same amount of tax on the same amount of income. We all have the standard deduction. We pay 0% tax on that. Up to the next X number of dollars of earnings, we all pay 10%. Up to the next X number of dollars, we pay 12%. And the next 22, 24, 32, and so on. Right? This is a big misconception. I hear people say, I don't want to make extra money. I'm going to throw me in a higher tax bracket. All the money that was in the lower tax bracket will stay in the lower tax bracket, and only the extra money will be paid in the higher tax bracket. And if you don't want to pay the taxes, send it to me because I know how the math works. Right? I like to, when I'm explaining it to people, I say, look, let's say I have $1. Let's say I have $100, and I say, I'll give you this $100, but you got to claim it as income, and it's going to cost you 12 cents in taxes. Do you still want it? Yeah. Right answer. Good. Now, what if it was $1,000. I said, now, if I give you 1,000, I could give you 1,000, but if I give you 1,000, you're going to have to pay 320 in taxes. Do you still want it? Good. Yep, that's right. You're still coming out ahead, aren't you? $680 ahead. You know, so, or if I said, well, I'm going to give you $100,000, but you're going to have to pay 99% in tax. So you're going to have to give the IRS $99,000. Do you still want the $100,000? No? Send it to me then, because I'm still keeping 1,000. I'm still 1,000 ahead, right? We're not. It's not a lie. You never come out negative in that case, right? You still always have a margin, and remembering that only the income in that higher bracket is taxed at that higher bracket. So the stuff about, you know, I hear people say, oh, I don't want to take overtime. I'll be in a higher tax bracket. I lost money. No, you didn't. That's not how the tax code works. You paid more tax on that piece. That's how welfare and entitlements work. There are problems there where if I have too much income, I might get an extra 1,000 of income and lose 30,000 of publicly funded benefits. That's a different thing, and obviously something we need to fix if we want to fix entitlements, right? But again, I'm not here to fix that today. We're here to raise money for the charity. So we can defer taxes on the sale of the assets. We can pay a lower marginal tax rate, spreading that income out over time, which progresses our tax rate less, right? Maybe I can keep that in the 12 or the 22 bracket instead of jumping into the 32 because I had so much income this year. So we can do some of that. And we can give more to the charity and less to the IRS, right? We're going to look at the 4 beneficiaries of your estate, and we're going to talk about how to draw up that estate plan. And you still receive a partial charitable deduction based on the value of the charitable interest in the trust. So there's a calculation that will be done to determine how much of your gift counts as a real donation versus personal benefit. There are 2 types of CRTs, the CRAT and the CRUT. Not the most beautiful of names, but the IRS is not known for beautiful names. The Charitable Remainder Annuity Trust pays you a fixed dollar benefit for a specific term, single life or joint life. So it could be as long as my spouse and I live. And it's a set dollar amount. It has to be at least 5% of what you gave. So if I did donate a $100,000 piece of property, my payment has to be at least $5,000 a year for the term of the trust or the annuity. And no more than 50% of the value of the property of the trust when it's established. In other words, my payment can't be more than 50% of the value of the trust. Now, obviously, the 50, you'll get that for about, well, I don't know if it's obvious, but you'll get that for about 20 months because you got to have a 10th, remember, remaining. You'll have taken 90% out in that time. Your trust will wind up pretty quick, but you'd still break it into a couple years. More commonly, it's toward that low end, 5-6%. The CRUT, Charitable Remainder Unit Trust, rather than paying a fixed dollar amount, it pays a fixed percentage of the value of the trust every year. So think of it almost like if I was living on the interest or the dividends in a trust, then I could have something like this CRUT that says, you know what, I'm going to give it to you, send me the earnings, and at the end of the term, keep the change. So it pays a fixed percentage. This could preserve more principal. It could increase or decrease with changes in the trust value. So if they've got stocks in there, they're fluctuating year to year. My income might fluctuate year to year. That might be desirable because it could fluctuate up if stocks appreciate over time, or it could be undesirable because I'm worried about planning-wise, I don't want it to go down. Same thing, payments must equal at least 5%, not exceed 50% of the value of the assets. Here, assets do need to be valued annually. If you had an account, you would just have a statement that valued that for you. Charitable deductions for contributions to a remainder trust. Now, what I give to a remainder trust is not fully deductible. Why? Because I'm getting a benefit. I'm getting that income. So they do what's called a present value calculation. Anybody here heard of a present value calculation? It's that time value of money thing. That's when you come up and say, what is $50K, $5,000 a year payment worth today? And you have to assume an interest rate, and they say the present value of future payments is X. So there's a calculation that's done. There's an IRS or Treasury regulation that tells us how to figure that out. And then that determines how much my benefit that I'm getting is out of it. That's how much I can't deduct or that I have to claim as income. And the difference is the charitable gift. Well, the nice part, when you look at the calculations, your deduction is a little greater than what the actual cost or benefit is. So it ends up profiting both you and the charity. Charitable gift annuity works the same. It just doesn't have a trust. It has an annuity instead. It's a contractual agreement between a donor and a qualified charity, where the donor makes a gift to the charity in return receives a fixed annual payment known as an annuity. The annuity is partly a gift, partly the purchase of an annuity contract. The charity uses the leftover for its purposes. One of the things we look at is how to set up an annuity funding rather than informal funding where you're sort of self-administering everything and hoping the grantor doesn't live too long so that you don't run out of money in the payments, right? Because the IRS might have calculated that you should have at least 10% left, but that doesn't mean you have 10% left, and you could have negative 10% left, and suddenly my gift became a curse on the organization, right? There are some ways to absolutely guarantee that doesn't happen. There's lower costs because there's not lawyers and trust documents involved. And the deductibility, as we talked about, depends on the present value. The discount rate, called the federal charitable rate, is stated monthly. Right now it's 4.6%. And you can choose to use that rate for the month or any of the 2 prior months. Right now the 2 prior months probably would have been higher. And the higher the rate, the larger the deduction, right? Because they're saying that sum of money is worth more today at higher rates than lower rates. So we made a handy spreadsheet to help you figure that out and sort it out and decide which one might be right for you. And you can kind of see key differences in the CGA, short for charitable gift annuity. CRT is all the other types of trust. And the CRAT and the CRUT are 2 specific subtypes. You can see the main difference. One's a contract with a charity, one's an irrevocable trust. One pays a fixed amount for life, one could pay fixed or variable. The CGA could be based on 1 life or more than 1 life. A CRT is a life or a set term of years. You don't have to revalue assets annually in a gift annuity. Income doesn't fluctuate. You can't add to it. You don't control the investment. It's got low complexity to set up. Trust is more complicated. Minimum gift, it's appropriate for gifts of $10,000 and up. A CRT typically $100,000 and up because of the cost to implement. Yes, you get a deduction. Partial just means depending on the value of your benefit from it. You do defer the gains. The remainder goes to the charity. That's true in both cases. The gift annuity's got more flexibility, or I'm sorry, less flexibility. CRT's got high flexibility. Risk of underpayment is low in the CGA. So if you say, hey, I want to keep it simple, keep the cost low, the gift annuity is probably ideal for you. So, looking at qualified charitable distributions, how do we keep the IRS out of your IRA? All right, I'm going to try to go fast. We're running. I was trying to keep to 2 hours for you, so which I'm a little over right now. So, illustrates tax savings on a QCD. I'm just going to show you a couple pictures. I find that, you start looking at all the numbers, listening to the words, kind of all runs together. Nothing's worse than talking about math, so that makes nonsense out of it pretty quick. So in this case, this is an example of a qualified charitable distribution to a nonprofit. No personal or beneficiary benefits for maximum impact. So if I have money, I've got clients like this, they really don't have anybody to leave the money to when they're gone, and they don't spend a lot of it. And we talk about what are you going to do with it? This is one of the things you can do even while you're living. Sometimes it's nice to see the impact using the qualified charitable distribution, kind of a before and after. The default plan, I like to say if you haven't made a plan, doesn't mean you don't have a plan, just means you get the default plan. right? The plan that the law has made for you. In this case says if you have an IRA, your kids inherit it, they're going to get $67,500 after the IRS gets their $32,500. So the IRS in this case, 1/3 beneficiary, your heirs 2/3 beneficiary. If that was your estate plan and you were picking up the beneficiaries, is that how you would draw it up? Nope. Rather, if you could disinherit one of these beneficiaries, you, your favorite charity, your heirs of the IRS, which one would you disinherit? The IRS, of course, your least favorite uncle. That's who you would disinherit, right? And so this person's not worried about an individual benefit. They're not worried about leaving it to the kids, or at least this money. They can give it all to the charity, completely disinherit the IRS, and maximize the benefit to the charity. What I call an IRA max concept incorporates life insurance for the individual who says, hey, I like this idea. I want to make meaningful gifts to the charity, but I don't like the idea of leaving nothing to my kids, right? I think a lot of people fit in that camp. So here what we showed is somebody using the QCD to the charity. They're buying a single pay life insurance policy to replace the heir's inheritance. So you put a one-time investment in the policy. They pay a 32% tax rate. The insured is age 71, so they're qualified, 70 and a half or older, standard health, $50,000 single payment in the policy. The $50,000 single payment in the policy, here the kids were going to get $68,000. You can see in the second scenario, the kids get $68,480, so a little bit more than what they had before on the $50,000 that went into the life insurance. There was $50,000 left. The charity got $34,000. The IRS got $16,000. But we didn't get to disinherit your least favorite uncle, but we did cut his inheritance in half, didn't we?
We did.
And we were leaving nothing to our favorite charity, and now the charity has $34,000. And the beauty of this, that $34,000 is free and clear now. And the kids, they get that life insurance tax-free. And I used whole life contracts, so nothing can go wrong on them. They'll actually increase in value over time. Here, looking at funding a gift annuity. If I'm uninsurable, annuity might be my only option. Here we're going to use that QCD to fund life insurance. We're going to fund an annuity with a life with cash refund settlement option. It'll pay me as long as I live. When I die, the change goes to the beneficiary on the annuity. Now, notice our tax bracket dropped from 32% on lump sums to 17% on annual income. The annuity remainder does reduce over time, the refund, as I collect payments from it. So we had the default plan on the left. On the right, we give that IRA to the charity. The charity sets up an annuity. The annuity pays me $4,200 a year, which is 4.2% distribution on the money, which is all the interest I'm making in most fixed income stuff today. The annuity remainder, the heirs are the remainder beneficiary of the annuity. So because they are, we have to claim the annuity as income. Okay? And so they're going to get this $49,700 year one, bearing in mind that's shrinking each year as you're collecting your $4,200, right? Because it's a remainder. And the charity, that $46,000 is free and clear. They can use it now. They don't have to worry about the annuity contract is funding the grantor for life. There's no risk of them outliving it, and you don't have to sit on the money and wait to know how much you need. The charity can use that money when they need money, which is now. That's right. And that's pretty impactful. Okay, and then this is the charitable gift annuity with a life insurance combination. So I give these things little names, kind of tells me what the recipe is. But we're going to use a charitable distribution to the charity. The charity is going to fund a lifetime annuity with a refund, but name itself the remainder beneficiary this time. And to take care of the heirs, they send me an income. I use the income. I buy a $75,000 life insurance policy, but I pay annually instead of single pay. Okay, so now I'm using lower income. I'll show you how this works. We had to add a couple squares to the thing. So I gave the charity the $100,000. The charity purchased an annuity. The annuity is paying out the $1,201 to the IRS, the $1,220 to me. Well, they're paying out all this to me. I'm giving $1,200 to the IRS. I'm spending $4,600 on my life premium, and I still have $1,200 left over, and that's my tip. Right? You get to keep the change what you didn't need. You could buy less life insurance if you wanted a bigger difference to keep for your free cash flow. The nice part here, so they used $90,000 to fund this contract. This one is ending up paying out over $7,000, right? So that's about 7% distribution. And now I'm using some of that for the IRS, some for my premium, and some for myself. I'm keeping 1.2% of that a year, which is about what my money market is paying me in interest. The $90,000 annuity purchase, the charity named themselves the remainder beneficiary. Okay, the $10,000 they didn't need for the annuity, that's clear, they can spend it now. The remainder after the first payment is $82,935. Depending how long I live, that will be shrinking year by year. You can see there's over 11 years of income there. And the heirs will actually be better off than they were if I left them the IRA. And those are all, remember, these are all knobs we can dial and adjust to suit you. And the IRS, because now they're only getting tax on my $7,000 a year payment rather than my $100,000 annuity. Okay? So that's using qualified charitable distributions. I love them for a planning concept. They're very powerful. The tax offset is to reduce tax liability. If you say, hey, I'm not 70 and a half, I can't use qualified charitable distributions. If you can't use those, you can still give money to the charity. We've got to take a distribution and we make a contribution. We withhold 0 for the IRS because we're going to give all the money away. Right? We're going to be able to itemize because we're doing a $50,000 or $100,000 gift. Okay, so yeah, I'm going to add an income and then I'm going to subtract an income. That's why it's a tax offset. Now, I can only do that up to 50 for this year, up to 50% of my AGI. Right? So in that $50,000 scenario, of course, the IRA is going to add to my AGI too, though. When I take it out, if I took $100,000 out of an IRA, I've got $50,000 of AGI right away before I add other income. You distribute it, withhold 0 for the IRS, you donate the proceeds to your charity. The charity buys a life and cash refund annuity with the $90,000, like in the prior scenario. Name themselves the beneficiary, like the prior scenario. Pays you $63.90 a year, which is 6.39% distribution. You buy the $75,000 life policy, name the heirs beneficiary. You keep the change. In this case, being younger, the change is $2,136 because my life insurance was cheaper, basically. The whole life policy also grows cash value and grows death benefit. You can get tax-free loans or take withdrawals from it. And that looks something like this. The charity's getting the same benefit, essentially. I'm getting a little more free cash flow because my premium was $3,200 instead of $4,400. The IRS gets a smaller inheritance, so the IRS is getting $1,086, and the kids are better off than they were if I just left them the IRA. Okay, Q&A.
Good job.
All right, thank you. So I know that was a lot, but if you have any questions you'd like to ask, now's a good time to do it. If your question is, can I go to the bathroom and go to bed now? You can do that as well if you like. Oh, but you can't do that until you get a word from the attorneys. They don't want to be left out of any presentation, which just says, I'm not an accountant, I'm not a lawyer, we sell financial products, annuities and life insurance policies aren't deposits in a bank, and not FDIC guaranteed, they're guaranteed by the insurance company, and if anything goes wrong, it's not whoever hired the lawyer's faults.
Right.
Right? That's the thing I've really come to understand this year is that whoever paid the lawyer, that's who the lawyer took care of. That's the key there. So that's why they make me put this here so that it's all my fault, right? But anyhow, thank you for your time. If you need to call my broker-dealer and tell them what an excellent job I did, there are numbers at the bottom. Or if you had a complaint, that would be the number to call as well.
If we have a complaint, we'll just call Frank.
Yeah, that's right. So anyhow, anything you want to ask this evening or?
And I would just add, even if you don't remember all this volume of material,
Yeah.
if we can explain all that to the individual
Yes.
on your behalf. And again, they have a number of options, but obviously they may want to make Calvary the primary option there. So
Certainly.
and we're willing to give our time to do that and not charge anything, I guess, for that purpose.
Yeah, certainly. No, I think it's,
You're giving your time.
yeah, exactly, exactly. That's,
Okay.
I think it's a good thing to do if we can, go out, help organizations kind of learn this stuff, help their members learn it. I think that can make a big impact for hopefully your organization and others. As I said, give less to the IRS, get more to the nonprofits is the big goal, so. All right, well, thank you all for your time this evening. It's a pleasure.
Thank you.
And hopefully that will help you in the course of your planning. You've got my cards in there if you want to call and ask questions about anything related to this or any other financial concern. You know how to find me.
Thank you, Isaac.
Thank you.
I plan on keeping it.
Well done, Isaac. We appreciate you being here, and once again, I appreciate them doing this because we can share this with a lot of people, especially in my part of development here at Calvary. This really gives me some help sharing with people and talking to them about this. And so, once again, I really appreciate what
My
you said
pleasure.
tonight, and thank you so much. And Charlie, people in your church, Graceway, Word of Grace, and my church, there's just so many people and young people, that's the thing. I tried to encourage the young people here at Calvary, you really need to be here tonight to see this, or to listen to this, because, and a lot of times, they think they do not really possess much, when in reality, they possess a lot, and they just don't realize it.
Mm-hmm.
And if they don't have a plan, guess, just as you
We'll
said,
make a plan for you.
who's
That's
gonna
what-
get it?
Yep.
So once again, thank you so much, and thank you guys for coming and being here tonight. It was a blessing to me, I hope it was a blessing to you. So, all right, thank you.
Thank you.